Welcome to this month's Economic Update. I'm Sinead Rafferty, Portfolio Specialist at MLC, and I'm joined by our Senior Economist, Bob Kineen. Welcome, Bob.
Hello, Sinead.
Bob, it's been a poor month for global share markets in August. What was behind the increase in volatility?
Well, it largely has to do with the trade tension between America and China. So August started off on a very bad note because President Trump announced a 10% tariff on $300 billion in Chinese imports. And then August, this crisis intensified. The middle of August, we saw another increase in the tariffs themselves. So primarily the weakness in the global share market, 2% fall for August, largely reflects the trade concerns.
And has there been improvement in that in recent weeks in terms of some positive sentiment coming out of that particular story?
Yes, so in the last week, so the first week of September as we talk, what we're seeing is that America and China have agreed to resume the trade negotiations. So now that's a bit of a more hopeful sign, if I could put it that way. But what we have to bear in mind, we've had 18 months of this trade war going on. So to say that we're nearer the resolution would probably take an optimistic view at this stage.
Okay. Now Europe's facing a lot of headwinds with the fallout from Britain's exit from the EU and also the recent numbers that are coming out of Germany in terms of a slowdown there.
Yep.
What's your view in terms of further monetary stimulus out of Europe?
Well, what we're seeing in terms of the European share market, so if you looked at the German DAX, the German share market fell 2% in August. British share market fell 4% in August, and that largely relates to the Brexit concerns. But what we're seeing in the European economy is weakness. So both Germany and Britain saw economic contractions in the June quarter, and because of this Brexit concern, because of these trade concerns in particular for German exporters, America is a key market, and from that perspective it adds to the downside risk for the European economy. Now the European Central Bank has signalled that it's willing to further ease monetary policy by cutting interest rates and perhaps stepping up in terms of asset purchases. So that's a hopeful sign, but in the immediate term we have to contend with a weak European economy.
Okay, on the back of that, and as a reflection of global slowdown, what we're seeing is that gold prices are at levels that we haven't seen since 2013. Is that likely to continue? Are investors getting nervous?
Yes, well there's quite a few gold bugs out there who are basically hoarding gold bars. And what essentially is happening is that gold is seen as a bit of a defensive asset class at the moment. Some investors are not willing to take shares as an investment, and they can see extraordinarily low government bond yields. So from that perspective, that's aided the gold market. But what we have to be careful with gold is that it doesn't deliver a yield. And because of that, it is an investment that will not deliver over the long term unless we have significant economic and political risks. So it's a bit of a safe haven at the moment, but it's not a sustainable long-term investment from a yield perspective.
What about the Australian share market? It was down 3% in August. What was the rationale behind that?
Well, what we saw in August with the Australian share market is particular concerns about the trade issue, but also the China slowdown. So for China, we saw industrial production data for July come in at its weakest since 2002. And what you saw is the iron ore price come down from $115 per tonne down to $85 per tonne in American dollar terms. So that's a sharp fall in the iron ore price. And what you saw is the resources sector underperformed quite dramatically. It fell nearly 8% in August.
Thanks for your time, Bob.
Thank you very much, Sinead.
And thank you for joining us.